Okay guys, so I'm sure you are well aware of this stock market bounce that we have been seeing as of lately. This is mostly fueled by inflation coming down more than expectations and Fed members signaling smaller rate hikes to come. But to be quite honest with you guys, I could sit here and make a video that is super skewed to the bullish side, and I could make a video that is super skewed to the bearish side, meaning that there's really a good argument for both sides here, a bullish and a bearish case for the rest of this year, and not only that, but for 2023. So we are going to be going over the bullish case, the bearish case, and my consensus overview of the next 6 to 12 months in the stock market. And you guys will get my opinion on this and what I think is going to happen at the end of this video. But nonetheless, before we dive into it, hit that like button for me. Make that button down there turn from gray to blue or gray to black, depending on what device you are watching this video on, and make sure to subscribe to the channel to stay up to date with all of your stock market needs. So let's first off start with the bullish argument for this market, because after all, we are currently in a bear market rally. And one of the most bullish things you could point to is the dollar, and this is UUP. This is a good way to track the dollar. And if you guys are unfamiliar with this, the dollar is essentially gauged from other currencies, right? So when this chart is going up, as it has been throughout basically all of 2022, that means currencies such as the Russian ruble, Chinese yuan, or Japanese yen, those currencies have been weakening, relatively speaking, to the dollar. Why is that so important? Well, for companies like Apple that do 55% of their business in foreign currencies, when they take in those weaker currencies and convert that back to US dollars, you obviously are going to get less US dollars. So that fundamentally hurts company earnings when the dollar strengthens, when the dollar goes up. As you can see from this chart, like I said, throughout all of 2022, it's basically been on an uptrend. And you can see this was the COVID crash. This was when people were panicking about COVID. And what happened after that? A massive bull rally in the markets. But look at the chart of the dollar. It was going straight down, meaning that global currencies were strengthening. The dollar was weakening. And that is good for company earnings. If you get a lot more, Russian rubles or pounds or Chinese yuans or Japanese yens for, in selling an iPhone or whatever and converting it back to US dollars, you're going to get more dollars if that conversion ratio is smaller. And like I said, it's been the opposite of that in 2022, but we have since broken down under key trend lines, and it looks to be that the dollar has a lot more room to fall from here than to rally. And there's a lot of reasons why the dollar has rallied in 2022, but a big one being high inflation and the fact that the Fed has been tightening at one of the most aggressive paces that we have ever seen in the history of the Federal Reserve. Simple supply and demand. When you are taking out dollars from the economy, restricting financial conditions, those dollars that are left in the economy tend to be more valuable. And that's exactly what we've been seeing since we got the lower CPI print, and now markets are expecting firmly a 50 basis point rate hike in December. Well, that is seen as a negative thing for the dollar, aka meaning the dollar going down, aka meaning positive for company earnings. And if you guys didn't get that, all you really need to know, when the dollar goes up, negative for company earnings. When the dollar goes down, positive for company earnings. That's the Econ Basic 101 version of what I just said. Now, a lot of this rally has also been behind TLT, or the bond markets, the bond yields going down. And essentially the opposite of the last chart we just showed. When this chart goes down, in which my cursor is at the beginning of 2022, it's virtually been going down all of 2022. That is a negative thing. And as you can see, the big bear market bounce that we got in August was the chart actually starting to go up. And when this chart goes down, it means bond yields are rising. When this chart goes up, it means bond yields are falling. And for obvious reasons, bond yields are competing assets with other assets, right? If a bond is yielding you 4%, And stocks are in this really turbulent phase of, are we going to keep growing? Are we going into recession? Well, bonds look a little bit more attractive, so it tends to take money out of the stock market, and it makes, for companies that need to raise capital, it makes that capital a lot more expensive. So for obvious reasons, when bond yields are going up, it tends to negatively impact the value of stocks, and that is what has been happening throughout all of 2022, but you have since hit a low and been bouncing back up. And just from the looks of this chart, it looks like there's more room to go higher here, for bond prices to go higher and for bond yields to fall. Now, this all depends on the course of inflation, and it all depends on what the Fed is going to do, and essentially why the Fed starts to slow down or even cut rates in 2023 will be very, very important for the bond yields, but we'll talk about that a little bit later on throughout this video. Another very bullish factor, I would say, for this rally as of right now is seasonality. November and December tend to be very strong months for equities, as it is the largest spending season of the year, and it looks to be that the American consumer, at least, is going to spend more this year than it did last year on holiday shopping. We're yet to actually get those numbers as of right now. It is Saturday, so I do expect to get more of those numbers coming out before the next week of trading, which is going to be on Monday, on November 28th. But another bullish factor of this market is that hedge funds, money managers, and just institutional investors overall have been so short on this market, and it has been very profitable for them throughout 2022. For some of them, right, the average hedge fund's down about 10% for the last year. The S&P was down 25% at its lows. NASDAQ was down 35% at its lows. Relatively speaking, it's been decently profitable. Well, when they're so overweight to those short positions, just to get back to a neutral kind of beta and delta, you are going to cause or need to cause a lot of buying in the markets just to get to neutral. So the more it looks like inflation is going down, the more it looks like the Fed is going to stop its tightening cycle, the more you will start to get this offset of buying compared to selling. And there's a lot of different data points you could look at this, but overall, even when you look at Friday, the option activity, 66.55% of the total option activity, the total open interest on that option chain was to the put side. 33.45% was to the call side. So remarkably bearish. Same thing for this upcoming Friday. 68.39% puts, 31.61% calls. And like I said, just to get back to neutral, you're going to need to see a lot of buying, and a lot of stocks are more reasonably valued after this sell-off. Now that some of the strongest bullish factors are out of the way, and I should mention before we get into some of the bearish factors that this Black Friday shopping season or time that we are in, you are seeing steep discounts. So it looks like inflation will continue to come down, and that is also another very bullish thing. But some of the bearish things, and one of the biggest bearish things, is valuations. And for the S&P 500, it currently has a PE ratio of 21.83. Next year's PE ratio is at about 19. Now, with the federal funds rate going to be at that time next year around 5%, and analysts still have about a 5% earnings growth rate for the S&P for next year, that looks to be too richly valued. And if earnings are actually negative next year, the PE could be way too expensive right now, just on an overall basis. Now, I will say with that, a lot of the S&P and the NASDAQ are controlled in the top 5 largest stocks in the stock market. Apple is 7% of the S&P, over 12% of the NASDAQ. Microsoft is over 5% of the S&P, over, I think it's 9% of the NASDAQ. So a lot of these earnings calculations are, by and large done with the largest stocks in the stock market. Depending how those company earnings do could set the indexes up next year for, a pretty flat or down year, or it could be very good if Apple and Microsoft, these large names, can actually outperform. But if earnings don't actually go up next year, it's going to potentially be a very negative thing for valuations. But some of your stocks that are beaten to a pulp might be actually too oversold. So from my personal perspective, it doesn't look like 2023 is going to be a good year for the index fund investor, but for bargain hunters right now, some stocks that are, at their COVID crash lows or right around there, you could actually see a very positive return in 2023. But that's one of my biggest concerns is valuation. I don't think earnings will grow 5% within the top 500 U.S. companies next year, especially when we are heading into a recession. It's pretty wide consensus at this point a recession is coming, and a lot of this, people are pointing to the 2 and 10 year bond curve, right? The yield curve inversion. It is steepening very, very aggressively, and you are at the most inverted, point than you have been at in all of history. And the 2 and 10 year bond curve or bond yield is very important because it is forecasted every recession before it happens since people started watching this in 1980. There's not been a recession that was not precursored by the inversion of the yield curve. Even in 2019, you've seen a brief inversion of the yield curve around July and August of 2019, and then you had the COVID pandemic. A lot of people, will point the hand to this and say we kind of knew something was coming. We didn't know COVID was coming at this time, but the bonds were definitely telling you something. And from right now, we are inverted 0.78 basis points, meaning that if you put up money for 10 years, you're going to get paid out less than if you put money up for 2 years. That is a very negative sign. And yes, I will point to the federal funds rate. The markets can go up when the Fed is tightening. As you've seen, one of the best examples from 2004 through 2007, the markets were actually rallying as the Fed raised rates from 1% all the way up to 5.25%. That was because underlying economics, company earnings were improving. And that's one thing about the stock market. You can trade off of fear and greed for so long, but in the end, company fundamentals are the most important thing. Now, where the actual pain tends to come in the stock market is during recessions. Historically speaking, look to the tech bubble, right? The Fed was raising rates the whole time. The markets were rallying. And then the Fed started to cut rates as the recession came. And that's where, for lack of a better word, shit started to hit the fan. And that's where, stocks started to go down quite a bit. Like I just said, from 04 through 2007, the Fed raised rates at a very aggressive clip. They really didn't stop or pause at all. And then the recession came, and that's when stocks got absolutely beaten down. So from my perspective here, you've seen the Fed raise rates from essentially 0 to where we currently sit at about 3.5%. Stocks have been falling. If we avoid a recession next year, that's going to be very good, but all indications are pointing to a recession is coming, and that's where you tend to get the real downside, is once that recession actually happens. And that, on the one hand, could make bond yields actually go down, meaning make TLT go up, but if it happens because a recession, or maybe it's even foreshadowing a recession coming right now, that is a very negative thing. If bond yields go, down because the Fed just stops tightening and we avoid a recession, that's going to be very positive. But as of right now, it does not look very likely that we will avoid a recession. So actually, when the Fed starts to cut rates before a recession, that's where stocks tend to see the most downside, at least in recent and past history. So those two things are really the two most negative things that are flashing red warning signs as of right now. My overall consensus of kind of what I expect over the next 6 to 12 months is a lot of choppiness. We're probably not going to reach all-time highs because people, investors, they're more focused on actual company earnings. And I don't think those largest weighted stocks, your Apples, your Amazons, your Microsofts, your Googles, are going to post huge increases to revenue and profits in 2023. I don't think that is going to happen, especially you've seen advertisers slowing down, you've seen layoffs coming. I think the last thing that is going to happen is record profits again, like we've seen in 2021. But what I do think is that a lot of stocks are undervalued. A lot of stocks that are, especially in the fintech sector, like a Square, for an example, super undervalued compared to its long-term potential. And I think that's where the real opportunity is. It's not in the indexes, it's in individual stocks that are beaten into a pulp. But my overall arching consensus is inflation's probably going to come down. Depending on if it comes down because of recession or the Fed just does, what it's supposed to do and it gets inflation down, that's going to mean a great deal to the markets. If we can avoid a recession and avoid an overall slowdown, the markets might trade sideways or even reach a new all-time high towards the end of 2023 or 2024. I'm much more bullish on 2024 rather than 2023. I think that's going to be the year of earnings contractions, and I think 2024 could actually be a more positive uptrend move in company earnings. Now, if the dollar does continue to fall as well, that is also going to help the earnings picture here. But from my point of view, I do think there's probably a new low coming once a recession does come. And based off of the yield curve inversion, it's almost inevitable that we will see a recession. And once recessions actually happen, that's when the Fed tends to cut rates, and that's when the markets tend to freak out and panic the most and actually hit those lows, guys. So that is my consensus. I do think over the next couple of weeks you could continue to rally, and I think we could get probably back up to the August highs around 430 on the S&P 500 if we do continue to see inflation coming down until we get to next quarter earnings. We have a while until we're going to hear from companies again, and that's where I think you could get more downside in a substantial way in the markets, guys. So that is it for this video. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Let me know if you're bullish, bearish, why you're bullish or bearish down below in the comment section. Thank you for watching, and I will see you in the next one.